Well, good morning, everybody. Good evening, wherever you are. Welcome back into the weekly webinar here with the Everyday Growth Advisors. Hope you guys are having a good weekend. We have a immense amount of things to go through this week. Topic of conversation and the focus in equity markets have really been mainly about the yield curve inversion, which is underway currently. This is a pretty nominal event that happens when the Fed undergoes a quantitative tightening cycle. We're also going to talk about the pullback on the S&P 500, where we are, where we're likely to head to, or what are the probabilistic and statistical scenarios in which we will be heading into a deeper pullback or a quicker recovery. If you can hear me, very quickly just type something in the chat so that I know that you can hear me. That would be greatly appreciated. And as usual, make sure that you leave a like and a subscribe if you're new here. We truly love having new people on board, and welcome to the tribe. Also, I want to talk about possible sector rotations today. And of course, these are not things that we set in stone, but we definitely see possibilities here. And we'll discuss all of these opportunities in this little quick webinar. If you have any tickers that you would like me to break down, go ahead and drop it in the comments as well right now, and then we can go through them together, and I'll help you to chart them out and do the best that I can in breaking it down. So, very quickly, can you guys hear me? Why does it say no data? Let me just make sure that you guys can hear me. Anybody? No? Wait, can you guys hear me? Is there something wrong? It's weird. Hello, hello. Okay, you guys can hear me. Okay, cool. All right. All right, excellent. As usual, we're going to take the same approach here. I'll go through a little bit of the macro stuff, and then we're going to go through the technicals right after that on the S&P, QQQ, IWM, Russell 2000, and then, of course, the VIX and the bond market. I'll go through a few opportunities this week, but majority of them is going to be on the private Discord community. I'll probably go through like 2 of them. Mainly sector rotational ideas and how you can play them, or how you can just take advantage of these minor arbitrage opportunities that arise in the market. As a trader, I feel it is very strongly your duty to do the groundwork and the legwork before the week starts to see where money is flowing, where money has flowed, and that will give you a really good idea on where the week is going to look like. It might take a little longer to get to your thesis or your idea, but you will eventually get there. So mainly, the S&P 500 saw a huge buy up in this past week, leading to this huge wave up. We mentioned that we might see some turbulence in this general region. Just make sure I can have this. In this general region, we mentioned that we might see some turbulence. So what is this going on? Here. And we did indeed pull back, but then it was a very short pullback. And then what happened here was the shorts continues, the longs continue to squeeze the shorts, causing that exuberance move into the 4600, where we had a gamma exposure of above the call wall for market makers and dealers. This was the level we were watching 4600 very closely last week, and actually consolidation and the break above was a very bullish break. Then came some profit taking towards Friday, which we already positioned for. We had some SPY puts on Thursday, which contributed to this little wave down, and that was mainly profit taking from this huge wave up. So we haven't really seen shorts pile on just yet. So remember this is very important information, and I'm giving it to you because I already looked at the data through the weekend, right? We don't have short positions increasing just yet. Remember that. A bunch of shorts just covered. So we don't have shorts building just yet. And when the shorts do start to build, and let's say that shorts are going to be on the institutional side, that's when we'll get the extended rally to the downside. And if we do get aggressive downside extensions, then the 4,300 is not out of question. Okay, it is not out of question. However, before 4,300, of course, we have other zones here which are more likely for us to hit on the S&P 500. So from the macro standpoint, we still see possible pullbacks based on uncertainty in the macro environment. Okay. Now, what is the background of the market right now? The first thing that we got to talk about is the yield curves, right? And what the hell is a yield curve? You need to remember that the bond market is consistent of a bunch of different types of bonds, right? So when the U.S. Government wants to raise, or the U.S. Treasury wants to raise funds, they have to, or rather the central bank wants to create tightening or loosening of the monetary policy, they have to pull in money or push out money, right, into the system. This is done through the open market operations, and when we have bonds, we have bonds that range in different types of expiries, right? So the years, the tenure of the bond. And each of these bonds, they pay coupon payments and whatnot, but they range all the way from a month to 30 years in nature, okay? Now, obviously, if you are a long-term bondholder, these typically, they would demand the highest percentage yield on the holding the bond, right? If you're holding a bond for 30 years, you would want to get paid the highest, right? And the person who gets paid, the person who's holding a 1 month bond would obviously get a very low return on their investment, right? And then the person holding a 10-year bond would usually get something in between, right? And we usually use the 10-year bond for valuations because it's in between, and it's the more what do you call it? the more sought after and liquid bond out of the whole bond market, right? So what's currently happening is that the shorter term bonds are now commanding higher rates of return than the 10-year and the 30-year. So we have typically three types of yield curves. You have a yield curve that goes like this, and then you have a yield curve that goes like this, and then you have a yield curve that goes like this. So there are three. There's one, there's two, there's three. Okay. Typically, when we have a economy that's pretty strong, or rather economy that's in a normal yield curve scenario, we have a normal yield curve like this. Okay, where shorter term bonds give you a lesser yield than longer term bonds, and this is when the market is, just rational, right? Then comes the transition between these two periods, which is scenario number 2, where the bond yields start to flatten. And scenario number 3 is when the bond market sniffs out the possibility of a recession. This is a recession scenario. Why? Because in this scenario, you can see what happens. The yield requirements for a bondholder for the shorter term become higher than that of the longer term. Now, I've exaggerated this drawing. Obviously, it doesn't obviously look like this, but you get the picture. The short-term bondholders are commanding higher yields percentage, right, than the long-term bondholders. Okay, this is the tenure of the bond. This is the yield percentage on this side. Just assume it as a graph. One is an inverted yield curve, and this is a regular yield curve, right? This is a flattened yield curve. Okay, so you have three scenarios in the bond market. Right now, we are moving into this scenario where we are starting to see a little bit of an inversion in the yield curve. And the inversion of the yield curve historically has predicted recessions, but not immediately, It's predicted it in the future. So like we're talking about 2 years down the road. Okay. But because we've had some really unnatural shocks to the economy, we really don't know if this inversion is actually going to lead to a recession. All right. In fact, it's a very mixed signal because increase in interest rates by the Fed signal a very strong economy. So that's a little bit of the macro of what's going on in yield curves and why it kind of matters. Now, I put out a big report on the T Subdish channel Discord explaining the yield curve inversion and also giving a little bit of update on it. And that's for our premium members to read. So it's just you need to just understand that historically speaking, markets tend to perform positively after yield curve inversions. 24 months onto the yield curve inversion, equities actually tend to outperform even when the economy is going into recession. Historically and probabilistically, the market still outperforms majority of the time. Okay, so that's your summary of the yield curve scenario. Now, also, the S&P 500 has risen by almost 9%, right? Since the low on March 8th, which is here, right here. And this has actually really taken a lot of, investors by surprise, right? In fact, a lot of light positioning and then immediate huge rally took a lot of people by surprise this past month or so. Now, historically speaking, also from another macro standpoint, we have the historical performance of the S&P 500 in April, which I will give you guys a little sneak peek into. So, April tends to be a very bullish seasonal month for the S&P 500. Actually, the second best month of the year, and mostly going back all the way to 1928, we have a 66% chance of the S&P 500 being up. But this past quarter, we saw a pretty big drop in the S&P 500. So that was a pretty challenging start to the year, right? And remember that our sentiment for this year, as we have been mentioning over and over again since last year, actually, we are expecting low, like single-digit growth in the S&P 500 this year, right? Mainly because of headwinds. We're also looking at supply chokes just finally clearing, Omicron that is just raging on, and then don't forget a very significant event, which is that this year is a midterm election year, and the stock market tends to underperform in a midterm election year. So that's another thing that you have to keep in your head. Okay. Of course, as I said, midterm year, we tend to underperform. You can see the number of times that we are actually positive versus negative. Actually, April still is okay, but then May, June, and then the middle of the year typically doesn't really fare well for the S&P 500 in terms of average return during midterm years. So this is a statistical thing that you should keep in your the back of your head when you're talking about or looking at markets in this way. We also have a decline in the equity risk premium, which has really just offset higher bond yields. And of course, there's going to be a further compression with the S&P 500 PE multiple. So we should see that heading into the year here, a lot of this should unwind, and the unwinding of it is really going to put a pressure on the 10-year yield, because it's a proxy for ERP, which is the equity risk premium, right? So there is a little bit of the macro part of this breakdown. Welcome in, guys. Hope you guys having a good day, good evening, wherever you are. Remember, smash the like button if you can. If you're here, you enjoy these breakdowns, you want help. Post stickers of what you want me to break down. Can help you with that. And yeah. So that's your yield curves talk. Let's talk about pullbacks real quick. So let's get into the technicals here. Now, looking at the technicals on the S&P 500, we had kind of a fake breakout, right? This is a fake out on, what was it, Thursday, Wednesday, somewhere around there. Now, I don't think it was an intentional fake breakout, or I don't think it was like a intentional reasoning for market makers to push that. But however, we do know the key gamma level for this week was 4,600. We broke that level, and then we started to consolidate above. But then right after that, people started taking profits. I know that it was profit taking and not short position building because of the market dealer positioning, and then on top of that, the put to call ratio plus the open interest net at the end of Friday, which I was looking at over the weekend, right? So really not much improvement or increase in short positions, but what we are seeing is profit taking, right? Profit taking from this huge wave up, which is very normal, right? So you always have to remember that what happens in the price cycle or price action cycle is you get a big wave up, then you have profit taking, then after profit taking you have another wave that tries to retest those highs, and if you fall short from there, then that's when you start to take your short position, because that's when shorts will start to pile in if we form a lower high here and then start to come down into whichever region that we'll see where demand comes in, right? So we have a couple of those regions. The first region, as we have always mentioned here, would be the 44.55. There's also the another region here in the 4,500. I doubt that we will hold 4,500. There is a very high chance that this dual zone here is defended though at 4,400. But the one that really is catching my eye is the 43.20. Huge volume shelf and a lot of liquidity in this region might force market maker action into this region in the next couple of weeks or whichever time zone, right? Because this wave up was so big, we would expect, and let's just hypothetically talk about this scenario where this wave is now completed, right? If we were to retrace this Fibonacci from here, and let me just change this real quick to my fib here. Okay, there we go. Yeah. So if we were, let me turn off this real quick. So just looking at the fib here, if we were to look at the 61.8 bounce would be 44.46, which roughly the area I was telling you about earlier. This would be a nice dual zone bounce, of course, right? That would be a nice first bounce. So maybe a projection into this region and then a bounce up to retest. That's a possibility. And then ultimately maybe a come down to bounce into the 38. But the 38.2, which is 43.20, would be a very deep correction. It's going to be past the 50. And so that will see... I think it's unlikely, but it's still a possibility. Okay, it's still a possibility. If we were to look at the extension of this wave, this is a pretty big wave, right? The extension of this wave, going back to the previous completed wave, was this wave right here. I think we have already hit the 61.8 extension in that wave. Yeah, we just did on Thursday or Friday. Here we go. So that wave's already completed now. And this was a big wave. So we're seeing that this extension here hitting the 61.8, rejecting, and then coming back down. They really failed to hold the 61.8. There is 44.84, and then, of course, once again, the 23.6 bounce retracement is going to be around this region here. But we'll see if the only way that we get down there is if we break, once again, 44.18, which is around 44.20. So these zones right here are very, very important zones, and I think that they will be significant in this week coming where we are economically and in terms of the macro environment. So the technicals here are pointing to a further pullback. However, it is very unlikely that we get down to 43.20 this week until and unless some crazy news breaks and then we got a big bearish wave going on to bounce in this strong demand zone over here. This is a lot of price action here that has defense level. Other than that, I think it's more likely that we bounce first on 44.80 or 44.20, around that region, somewhere over here, right, in this region. This seems to be the more probable region. And then another wave up if we get continuation on the bull side. All right. So that's your technical update for the S&P 500. Now let's look at the Qs real quick. Similar looking chart, and let's look at where those levels are for QQQ here, assuming that this wave is now complete. Once again, the 351, and then you have the 338, 335. This is another region here. This is the equivalent to the 4320 on SPY. So if we come down all the way, that's where we're going to come down to, which, you know, I highly doubt that's going to happen. I'm going to delete this one away and this one away. We don't need those now. This is your last line of defense here, way down, so I don't think we'll ever get there. But you can see that we're kind of moving into like a megaphone pattern here. And with megaphone patterns, we could easily just go back up and really retest all of these higher levels up here, which are possible probabilities in the future, right? In the future, not now, but in the future. So pullback on, what are the likely pullback levels? 351.28, right? That's a very likely pullback level on the Qs. We have also above us, these were all likely extension levels and pullback levels. But 351.28, 61 bounce. If we really get below that, then we're looking at either 345, which is a 50 bounce. But I don't think we defend there. That doesn't look like a lot of price action. Let's have a look at the volume shelves here as well, very quickly, to see what's going on here. So you can see once again here, a lot of liquidity is sitting in this region here. And then right after that, if you look further back, considering all of this price action, well, let's not consider so much of it. Let's just say till this wave here. This looks more probable. Yeah, this is good. So if we do break below the 358, 357, let's say this region here, then the liquidity gets pretty sparse all the way down into, I want to say 340s. So that 61.8 zone is a very, very likely zone for us to come and close here, right here, 351. So the pullback that continues there would see a bounce, a very short bounce here with the Qs. I think that tech is going to likely see that pullback. And as I always say, the playbook here, when you look at tech pulling back, is pretty simple. You look at semiconductors and all of the high beta stocks. You want to look at the highest beta ones to play short positions on, because volatility is the highest there. And when volatility is the highest, the fear is going to be more peak, and all those algos that trade between them, they will likely let go of those positions more quickly. So that's your QQQ update. Once again, my forecast for this week is a slight pullback. It's not a crazy pullback because I don't intend for us to go down all the way down to 43.20 so quickly. But I do think that because of the way the volume and liquidity engineering is going to work here, we might see this level get retest. However, it's less likely now until we see what happens at 4400s and QQQ 350. Let's just 350, right? 350 even. So that will be your update on QQQ, bounce on 350. If we get lower than that, then there's likely to be a bounce at 342 or 335. Those are the three key levels here for bounces to come in based on volume and market maker positioning. Let's look at IWM real quick. So if QQQ and SPX come down, then there is also a possibility that IWM comes down. But however, I want to say, the Russell has been pretty resilient this past week. So we'll actually see what happens as we get into this coming week. I somehow feel growth, tech, and a lot of those higher beta names in terms of growth are seeing inflows. But it's also, I feel, a ploy to trap people. So we can't exactly be sure. We did see a bounce above this channel, but I feel like we have to be extremely cautious because this could be a fake out, and then IWM comes down, retest these levels here. So I'm very sheepish to take IWM where it is right now. I do have a short position that I'm building, but not a very big one, just a very small short position down into the 196s to retest this bottom channel once again. We are in no man's land here on IWM. We broke below and then we rejected this week at the dual zone here. So I'm of still the inclination that Russell is leaning more bearish than it is bullish as of Friday. Okay. Will I be right? Probably not. But you know, I'm just going off probability and statistics here. Of course, then we have the VIX, which has had a whole week or more of continued outflow of volatility, right? Below 1881 is very bullish, but we are likely to see a spike in the VIX this week. We just don't want to cross 2389. Anything, you know, even if we get up to 23, it's fine. Above 2389 is where fear starts to come back in, and we are just coming out of the fear indicator right now. For those of you that don't know where we are in terms of the positioning for fear and greed, we're in neutral right now, and we are just coming out of fear. So we haven't really pivoted into much of the other expectations here. The VIX spiking here would be very normal because we've had a pretty big pullback, and that we should expect that. So this all goes hand in hand together, right? Remember, confluence. You need to look at everything at the same time, and then that would make a lot more sense to you. Next up is TLT. We talk about the bond market real quick. So on Friday, we had an attempt to flush out shorts here, and then immediate buy up based on, I think there was news as well on the Fed chair, one of the Fed chairs saying that they are likely to start QT in May. So the bond market reacted favorably, and they're starting to have some appetite for bonds right now. I still have a rolling TLT position. I took profits on the first half, and now I rolled my strike into 134 into this little mini dual zone up here. So just trying to get a squeeze out of this oversold market on the bond market here. Excuse me. And yeah, that's all I have in terms of updates for TLT. Of course, once again, it's not typical for you to buy bonds when the Fed is about to perform quantitative tightening. But remember that this has already been priced in. So now, remember that investors don't go off what the Fed is about to do. They forecast it, they go ahead of it, and then now when the Fed is about to, you know, do the reverse and start selling these bonds, then they'll start to buy those bonds at the same time. So it's kind of like the reverse. They're doing, the bond market is doing what the reverse of what they expect the Fed to do, and sniffing out what is actually going on here. Okay. All right. Well, hi everybody. How are you guys doing? What's up? What's up? Do you guys have any tickers for me to break down? If you do, put them in the comments so I can do them. Let me just show you a couple opportunities I'm looking at. Cybersecurity, very, very strong space right now still. Very strong bounces across the board on 3 tickers. You have DDOG, you have CrowdStrike, and then you have, what was the other one? DDOG, CrowdStrike, and I think there's another one. NetEase, is it NetEase? I'm not sure if that's the one. But I personally like CrowdStrike and DDOG. They're looking pretty nice. Very bullish price action. Breaking a key pivot here, 152 with DDOG. Looking for the upside extension into 165. We'll see if we get it this week. I don't know if we will. We're seeing a lot of rejection here as well. But either way, if the position doesn't go my way, I'll take a hedge against it and then start taking the downside here. Remember that if you're long in a position, don't be afraid to take the opposing position in the temporary interim. Take a short position, protect your long, and then reverse out the position when you have made profits on either side, right? So there's always opportunities to fix your wrongs if you made a wrong decision. CrowdStrike's the other one, but I don't really want to get bullish on this until I get above 232 here. That's another opportunity that I'm looking at. Now, semiconductors have been absolutely demolished. Well, AMD and NVIDIA specifically this past week. Actually, a lot of semiconductors were demolished because of Qs, right? The Qs falling saw, and then AMD with some news, I believe it was, what was the AMD news that came out? I remember it was something, what was the, oh yes, it got downgraded, right? It got downgraded by like a bunch of analysts at the same time. However, I will say something. If AMD can come and recover above 110 or 111, I am very inclined to play this at the upside. This is a very nice breakout on the descending triangle, and then the retest right here. If it can break above 111, I will be long AMD. getting into 116 or 115. There's a nice gap to fill at 120. Probably won't go that far out, but I will be likely to take this to the upside if it breaks 111 or 112. Let's just say 112. Okay, low. Let's do low. Shopify is another interesting one. Oh, this one got demolished also. Oh yeah, so this is a nice setup for a short position here. This is looking nice. This looks like a good one for, let's see here. So demand zone comes in somewhere around here. Looks like a decent amount of downside. A break below 201. Yep, exactly 201, let's just say. Boom. Sees the downside extension, but I do want to pull back first. Let's see if we can retest this dual zone here. Would be nice. Let's see. So we're looking at this level here. This is now going to be your dual zone. We kind of want to see a rejection here. I would say somewhere around here. So a 212 rejection could see the downsides, the downside here. I don't know if I want to play the short right off the bat if it breaks, but then again, it seems like it wants to do that though. Yeah, this one looks like a good opportunity this week for a short position. I like it. I like it. I just think I don't want to buy puts here. I want to wait for the pullback into 212, this dual zone right here, and then pick up the short position here to play down and retest into 200s. And honestly, I would, if it gets up to 212, then I'll just do the 200 put and play the retest down here. That's it. Rejection, confirmation, play the retest at 200 and get out. I don't need to chase the downside here because there is no confirmation that you're actually going to break below this, since this is a pretty strong demand zone here. So that's how I would play this. A pullback and then a retest. If it gets rejected, play this back down instead of playing the move all the way down here. That's what I'm thinking here. I think a lot of people will try to play this move down here, which I think might be messy because it's a big wave down. And a big wave down always comes with a pullback. So you play the pullback rather than play the extreme downside right away. That's what I'm thinking. Any other tickers? If not, we'll keep this live stream short and sweet. Oh yes, so then the last thing I wanted to talk about was sector rotations. So for those of you that are on the premium Discord channel, I just wanted to update you guys on the sector rotations, right? So I already posted the sector sentiment, and as we know, this week's update is looking very similar to last week, except for there are some differences. Financials are still looking shortable. Energy is still looking shortable, but it requires more time. Retail shortable. Semiconductors overbought but cooling off, right? Utilities are very overbought, and so we should look at accumulating a position. Either we want to see the irrational utilities side come out first, and then we take the short, but it's very easy to manage your risk on utilities right now. And then, of course, technology being pretty overbought at this point as well. So a lot of things are overbought after this big, massive rally on the S&P 500, which is the reason why everything coming together as confluence does signal to a downside slide for a little bit. Whether it's a deep slide down or a mini slide down, we don't know, right? We'll know only through the week as we see the gamma positioning from market dealers, and then we start to see the individual grains within the market coming out from the woodworks this week. So if you want that play-by-play update, just join the Discord channel. You'll hear from me updating every single day of the week when the market opens. Okay. Yeah, Home Depot. Yeah, it's a similar looking chart, right? I saw that with Home Depot. Yeah, this is another one. So Home Depot has more downside though if it does break. So I think the 324 rejection, or actually lower even, maybe 316, 317 rejection on Home Depot. Could slide down to 300 and play that the pop up and fall down here. But if it does break below this and starts rejecting, then there's a lot more downside here, I think. I think 285 is a pretty decent downside here. Could really go all the way down here though. This were some of the COVID stocks. Remember when everybody was talking about home improvement, and these companies were bought up like crazy because of that during the COVID slide, right? And projections of revenue were out of whack, and Lowe's and Home Depot and all of those, right? And now we're looking at these companies cooling off and reevaluating their revenues and forecasts. So that's something that you have to keep in mind. Okay, well, there are more opportunities, of course. I'm going to post them on the snipe list for you guys, those of you on Discord. And also, remember, guys, those of you that are taking the beginner's course, I'll see you in class tomorrow in roughly less than 24 hours. If you haven't signed up for the beginner's course, you have a last chance to sign up, like, within the next, I would say, 12 to 16 hours. That's when I'm closing registration. So I'll see you in class. And apart from that, I'll see you guys on the next weekly webinar. I hope this was helpful for you. If it was, smash the like button, leave something behind. Leave a comment. Let me know if these help you out. And yeah, we'll see you guys next week. So take care and peace out. Bye-bye.